The markets actually have in a very narrow range with some amount of pressure coming in. The broader markets were actually rebounding smartly, but right now they have also reversed their bulk of the gains. So there is a worry on the mind of the market. We'll discuss that with Rahul Singh, who is joining us, the CIO at Tata AMC. Rahul, good afternoon. Thank you so much for your time. Now let's start by the main point which is on the mind of the market right now, and that is either delayed cuts there in US, or even Chetan Aya of Morgan Stanley this morning has put out a note saying no rate cuts this year in India. So the narrative which was building that probably there would be some rate cut in the second half of this year, ever since US retail sales and CPI data has come in, that narrative seemed to have gotten challenged, and because of which yields have rallied. What is your own hypothesis? I'm not even going whether it's a very huge factor for markets or not, but this is clearly a factor which market was watching very closely.
Right. So I think there are two factors at work in the market. One, obviously, as you mentioned, the rate cut and whether that gets delayed and by how much, and whether we have a rate cut this year or not. I think those discussions have started again, and this is not the first time that there is a flip-flop in terms of the consensus view on the rate cut. So I'm not entirely surprised. So that obviously has an impact on equity valuations, although I must say that in India, the scenario as far as inflation rate matrix is still much better. And also, despite the high rates entire last one and a half years, the impact on the demand for the rate sensitive sectors like real estate or autos did not really get impacted. So I'm not very sure whether fundamentally, if there are no rate cuts this year in India, whether it's necessarily a bad news for the numbers, for the demand per se, because it did not destroy demand over the last 1.5 years, which was the fear that if the rates remain high and when the rate hikes happen, whether, for example, real estate demand will slow down, but it's hardly slowed down. So that's number one. So I would think that is not really a big issue for the fundamentals for the economy or for the earnings growth. As far as the other factor which is concerning the markets in terms of valuation is that so far India has had a perfect macro, which is under control or broadly under control. Inflation, the current account deficit, fiscal deficit, all trending downwards. Now, for the first time, there is a real threat that if the conflict in Middle East escalates, and if it results in higher crude prices than what we have got used to between 85 to 90, then that can disrupt a lot of mathematics for inflation, current account deficit, even fiscal deficit. So I think that's a bigger worry rather than the rates per se, in my view.
Fair point. Rahul, I wanted to understand, your thoughts on the way monsoon and markets and monsoon and economy, the correlation we've had. No matter how much we say that this correlation is coming down, but there is a large section of the economy which is directly dependent on monsoon. This time, of course, the estimate so far is that it's likely to be a good monsoon, but consumer stocks, FMCG in particular, haven't gone anywhere for a very long time. And some of them are at 52-week low, for example, HUL. Do you see an investment case building, any green shoots of recovery in the rural side which you foresee?
So far, we are not seeing any green shoots of recovery. My own sense is that if the urban economy continues to outpace rural economy, because there are a lot of interlinkages in the way the economies work, I think sooner or later the rural economy will recover, but not necessarily due to agricultural income or monsoons, but purely because of the amount of capex and construction activity which we are undergoing and which is likely to continue post-elections. So my sense is that, in the rural economy, there is agri income, there is non-agri income. I think the non-agri income will start to show signs of recovery in the second half. But as of now, to answer your question, there are no green shoots visible as on date.
Rahul, I wanted your thoughts on real estate space. That is one space your house is bullish on. And why not? I mean, the data speaks for itself, be it launch data, volume data, and in fact, absorption data as well. I want to understand which phase of the cycle are we in as far as the real estate space is concerned.
Yeah, that's a good question. I think we have gone past the mid cycle. We are not in late cycle. Typically, the signs of late cycle are that you will have investor demand, you will have price increases in the real estate sales of 10, 15, 20% within the space of 6 months. We are not seeing that, barring one market, which is the NCR market, where there are early signs of price increases outpacing the affordability. But even there, the demand is keeping pace. So essentially, my sense is that our sense is that we are definitely past the mid cycle. We are moving towards the late cycle. But as long as the genuine demand is there and the price increases are in the high single digit kind of range on a yearly basis, I think we can sustain this cycle for longer. So what we might see is that the stage of the cycle, really what I'm trying to say is also dependent on the micro market which you are looking at. A Bangalore market can be very different from NCR, can be very different from Mumbai market. But overall, if I have to give you one generic answer, I think the low-hanging fruits are gone. I think clearly the sector is doing very well. The launches, there are big launches planned even in the next financial year. Most of the real estate companies are guiding for anywhere between 10 to 20% pre-sales growth this year, which I think should happen. The question is that what happens post that, whether there are more launches planned at higher prices, whether there is investor demand which comes in at the later stage this year. I think those are the signs one would have to look at very carefully, because that is when you typically peak out in terms of a real estate cycle.
Okay. The other space, I see you have very good exposure and you're positive on in the entire manufacturing theme, which I agree with. But does valuation become a bit of a challenge in some of the capital goods names and manufacturing related ancillary, or you are okay with buying slightly on the expensive side if the structural story is very strong and intact?
No, you're right. I think valuations are becoming a challenge for some of these themes of infrastructure, capital goods, as well as manufacturing. At the same time, the sample size is very, very large in terms of the choice we get in terms of different sectors, different companies. We are still able to take our picks and build a portfolio which is not very expensive. Just to give you a sense, if you look at our small cap fund, which has a large proportion of manufacturing sector in it, our portfolio PE is at 25% lower than the benchmark PE of small cap. So essentially, you have to be more patient and you have to hunt for those companies or stocks where the valuations are still reasonable. So far, I think it's a slow process. It's become more difficult as the time has gone by, but it is not. It's not something which is completely impossible at this stage.
Okay. Fine. All right, Rahul, we'll let you go on that one. Thanks so much for joining us on the show today.
If you like this video, then like, share and subscribe to ET Now.